Imagine two traders sitting side by side. Same charts, same strategy, same market. One quietly builds wealth over time. The other slowly drains their account and has no idea why. Now here's the uncomfortable question. If trading were just about intelligence, logic, and analysis, wouldn't the smartest people dominate the markets? Wouldn't every engineer, data scientist, and finance graduate be printing money? But that's not reality. Plenty of highly educated, analytical people struggle in trading. Some even fail spectacularly. Meanwhile, average people with simple strategies sometimes outperform them. So what's really going on? Here's the truth most beginners don't want to hear. Trading is not a knowledge game. It's a behavior game. And until you understand this, you'll keep searching for better indicators, better systems, better signals, when the real problem is sitting between your ears. Trading looks like it should reward intelligence. You get charts, data, probabilities, patterns, news, models. It feels like a puzzle for the logical mind. So, smart people enter thinking, I'll just follow the numbers. Easy. But then reality hits. 2 weeks later, they're breaking their own rules, moving stop losses, chasing trades they missed, doubling position sizes to recover losses, closing winners too early, holding losers too long, and they say the famous line, I knew what I should have done, I just didn't do it. That sentence right there sums up the entire struggle of trading, because most traders don't lose from lack of strategy, they lose from lack of self-control. Let's be honest for a moment. How many times have you predicted a move correctly? You saw the setup, you told a friend, you even marked the chart perfectly, and price went exactly where you expected. But did you actually make money? Or did you hesitate and miss the entry, or panic and exit early, or overstay and watch profit turn into loss? This is the painful gap between being right and being profitable. Analysis can make you right. Behavior makes you money. Picture a typical day for a trader. You open your charts. A setup is forming. Everything lines up. Trend, levels, confirmation. Your plan says enter, but your mind says, wait, last time this failed. What if today is different? Maybe I should wait for more proof. Suddenly you're frozen, not because of the market, but because of your thoughts. Or maybe you enter the trade. Now every tiny price movement feels huge. Your heart beats faster. You check your phone every minute. Your target suddenly feels too far away. You start negotiating with yourself. Maybe I'll just take a small profit. Better safe than sorry. Nothing changed on the chart. Only your emotions changed. And that's the hidden battlefield of trading. The market isn't your biggest opponent. Your reactions are. You can spend years learning technical analysis, but if you can't handle fear, greed, boredom, and doubt, that knowledge won't save your account. Because in trading, knowing the right move doesn't matter if you can't execute it when it counts. And this leads to a powerful realization. Many traders already have strategies that could work. They just don't have the discipline to follow them consistently.
Let's talk about something most traders underestimate. Your brain was not built for trading. That's not an insult. It's biology. For thousands of years, the human brain evolved for survival in dangerous physical environments. Your ancestors dealt with predators, food shortages, and immediate threats. In those situations, fast emotional reactions kept people alive. See danger, react instantly. Lose resources, recover quickly. Find safety, hold on to it. Those instincts made sense back then. But in trading, those same instincts can wreck you, because trading asks you to do the opposite of what your brain prefers. Trading asks you to accept small losses calmly. Your brain hates losing resources. Trading asks you to wait patiently. Your brain prefers quick action and quick rewards. Trading asks you to stay calm under uncertainty. Your brain wants certainty and control. So when you take a loss, your system reacts as if something real was taken from you. Stress hormones rise. Your heart rate changes. Your body enters a mild threat state. Logically, you know it's just a trade. Biologically, your brain feels attacked. And when people feel attacked, they don't think clearly, they react. And this is where revenge trading is born. You lose money, your brain wants it back. Not strategically, emotionally. So you jump into the next trade too fast. You size up. You abandon your rules. You're no longer trading the market, you're fighting your feelings. And the market always wins that fight. But here's something interesting. Winning can be just as dangerous as losing. A few good trades in a row can make you feel unstoppable. You start believing you've figured it out. Then your discipline slips. You take trades that aren't really there. You risk more than usual. You ignore your system because this one feels right. And this is called recency bias, your brain giving too much importance to recent outcomes. After wins, you feel invincible. After losses, you feel hopeless. Neither state is good for decision-making. Consistent traders don't ride emotional highs and lows. They stay steady. Now think about this. Have you noticed how your discipline changes during the day? Maybe in the morning you're focused, you follow rules, you're patient. But later in the day you get sloppy, you force trades, you bend your rules. That's not random. It's something called decision fatigue. Every decision you make during the day uses mental energy. What to eat, who to reply to, what to prioritize, what to ignore. By the time you're deep into the day, your brain is tired, and a tired brain chooses easy over correct. And trading, the easy choice is usually the wrong one. This is why many professional traders limit their trading hours, not because of the market, but because of their mental state. They protect their decision quality. Here's a powerful idea. Your strategy is only as good as your ability to execute it when tired, stressed, or emotional. Two traders can use the exact same system. One makes money, one loses. The difference isn't the system, it's the execution. The profitable trader follows rules even when it's uncomfortable. The losing trader follows feelings. One treats trading like a process. The other treats it like a reaction. And over hundreds of trades, that difference becomes huge. This is also why demo trading can be misleading. When no real money is on the line, your notions stay quiet. You take trades calmly, you follow rules easily. But the moment real money enters the picture, fear and greed wake up. Suddenly, everything feels different. Because the real challenge of trading isn't clicking buttons, it's managing yourself.
Let me tell you about a trader we'll call Arjun. Arjun was the kind of trader people admired in online communities. His chart analysis was sharp, his levels were clean, his market bias was often correct. Other traders asked for his opinion. Some even copied his ideas. And honestly, his predictions were right more often than wrong. But there was a strange problem. Arjun wasn't making money. In fact, his account kept shrinking. How is that possible? How can someone be right so often and still lose? The answer is uncomfortable but important. Arjun was a great analyst, but a poor executor. When he shared analysis publicly, he was calm, detached, objective. But when he traded his own money, everything changed. Suddenly, every trade felt personal. Every loss felt like failure. Every win felt like relief. He'd enter late because he wanted extra confirmation. He'd exit early because he feared losing profit. He'd hold losers because admitting he was wrong hurt his ego. The chart didn't change. His psychology did, and that changed everything. Here's the key lesson from Arjun's story. The moment money becomes emotional, discipline becomes difficult. Many traders think awareness is enough. They say, I know my weaknesses, but knowing doesn't equal control. You can know you shouldn't overtrade and still overtrade. You can know your stop loss is there for a reason and still move it. You can know patience is important and still chase trades. Because in the heat of the moment, knowledge gets quieter and emotion gets louder. That's why trading psychology isn't about information, it's about training your responses. Think of it like a reflex. If someone throws a ball at your face, you blink automatically. In trading, many reactions are just as automatic. Loss translates to revenge trade, win to overconfidence, missed trade to chasing. These are conditioned responses, and what's conditioned can be reconditioned, but it takes structure and repetition. Now let's talk about a dangerous myth. Some people believe successful traders are emotionless, like robots. That's not true. Profitable traders feel fear. They feel doubt. They feel excitement. The difference is simple. They don't let feelings make decisions. They create a gap between feeling and action. Inside that gap lives discipline. Discipline isn't about being tough. It's about being consistent. It's taking the stop loss even when it hurts. It's taking the next trade after a loss. It's sticking to position size after a win. Small acts of discipline repeated daily create long-term results. Now here's something most people overlook. Behavioral mistakes don't always punish you immediately. Sometimes breaking rules still leads to a win, and that's dangerous because your brain learns breaking rules works. But over time, those small deviations destroy your edge. Trading is a numbers game across many trades. One good or bad trade means little. Your habits across 100+ trades mean everything. This is why some traders do well for months, then suddenly blow up. Their strategy didn't fail. Their discipline slowly eroded. One rule bent, then another, until risk spirals out of control. Consistency isn't exciting, but it's what keeps traders alive.
Let's talk about a tool that quietly separates struggling traders from consistent ones. Preparation. Not indicators, not secret strategies, preparation. Most traders skip this completely. They open charts randomly, scroll markets, and jump into trades based on what looks good in the moment. That approach feels active, but it's reactive, and reactive trading is emotional trading. When you make decisions on the fly under pressure with money on the line, your emotional brain takes control. Now compare that to a prepared trader. Before the market even opens, they already know what setups they're looking for, what markets they'll trade, where key levels are, how much they'll risk that day, when they will stop trading. They've already made the hard decisions while calm, so during live markets, they're not deciding, they're executing. That's a huge difference. Preparation reduces emotional pressure because fewer decisions are made in the heat of the moment. Think of a pilot. Pilots don't improvise mid-air. They use checklists, not because they're inexperienced, but because structure prevents mistakes. Trading is similar. A simple routine can dramatically improve behavior. For example, review higher time frame levels, mark key zones, define risk per trade, set daily loss limits, visualize sticking to rules. Notice something? None of this predicts the market. It prepares you. And that's the real goal. Because the market will always be uncertain, but your behavior doesn't have to be. Now here's another sensitive topic many traders avoid. Trading with scared money. If you're trading money meant for rent, bills, or family needs, your brain treats every trade like survival. You cannot be objective in that state. Every tick against you feels painful. Every drawdown feels threatening. So you interfere, you micromanage, you panic. It's not weakness, it's human nature. Proper position sizing isn't just math, it's psychology. A good rule is this: if a single trade loss affects your mood, sleep, or confidence, you're risking too much. The right size is the size that lets you stay calm and follow your plan. Professional traders understand this deeply. They focus on protecting mental capital as much as financial capital, because once emotions spiral, mistakes multiply. Let's look at another interesting contrast. Some traders use very simple strategies, maybe just support and resistance, maybe one or two confirmations, nothing fancy. Yet they're profitable. Meanwhile, others build complex systems with many indicators and filters and still struggle. Why? Because complexity gives emotions more room to interfere. If your system has 10 conditions, your brain can always justify breaking one. Simple rules are harder to bend. Clarity supports discipline. This doesn't mean simple is always better. It means clear is better. A strategy you can follow consistently beats a perfect strategy you don't follow. Now here's a powerful truth. The market doesn't reward intelligence. It rewards consistency. It doesn't pay you for being right. It pays you for managing risk and behavior. Many traders secretly chase excitement. They want big wins, fast results, adrenaline. But sustainable trading is often boring, routine, repetition, risk control. And boring is good because boring is stable,
and stability compounds. Let's talk about something subtle but extremely powerful. Small behavioral mistakes. Not the obvious blow-ups, not the dramatic account wipes, the tiny deviations that seem harmless in the moment. Because most traders don't fail from one big mistake. They fail from many small ones that compound. For example, you exit one trade early because you felt nervous. No big deal, right? Then you do it again next time, and again. Soon, you've built a habit of cutting winners short. Your strategy might require a 2-to-1 reward-to-risk ratio to be profitable. But if you keep taking profits early, you quietly reduce that to 1-to-1 or worse. Now your winning system becomes a losing one, not because the strategy failed, because behavior changed the math. Here's another one. You move your stop loss once because this setup looks strong. It works that time. You avoid a loss. Your brain learns moving stops saves money. So you do it again and again, until one day a small planned loss turns into a huge one. That's how accounts bleed, not from ignorance, from inconsistency. Trading success is built on statistical edges. Statistics only work when rules are followed repeatedly. Imagine flipping a coin with a slight edge. If you randomly change the rules mid-game, your edge disappears. Trading is the same. Now here's a concept many overlook: delayed consequences. Behavioral mistakes don't always hurt immediately. Sometimes they reward you first. That's what makes them dangerous. Breaking rules can still lead to wins, and those wins reinforce bad habits. It's like eating junk food and feeling fine today. The damage shows later. In trading, later can mean months down the line when your results suddenly collapse. You might blame the market or your strategy, but often the real cause is slow discipline erosion. One skipped rule here, one impulsive trade there. Over time, it snowballs. Now let's flip the perspective. Small good habits compound too. Taking every valid setup, respecting stops, keeping size consistent, stopping after your daily limit. Individually, they seem minor, but across 200 trades, they define profitability. This is why journaling is powerful. Not just logging entries and exits, but tracking behavior. Ask after each session, did I follow my rules? Did emotions influence decisions? Was I patient? Did I size correctly? You're not just reviewing trades, you're reviewing yourself, because you are the system operator. A great system run poorly loses money. An average system run well can win. Here's another truth. Many traders are addicted to action. They feel the need to always be in a trade. But the best traders know that no trade is often the best trade. Patience is a position. Waiting is a skill. Sometimes the most profitable decision is doing nothing. That's hard for the human brain because inactivity feels unproductive. But in trading, overactivity is expensive. Think like a sniper, not a machine gun. Precision over frequency. Now consider this. If you followed your strategy perfectly for the next 100 trades, what would happen? Most traders never find out because they interrupt the process. They change rules mid-sample. They strategy hop. They react emotionally. Consistency reveals edge. Inconsistency hides it. Let's talk about the moment that separates amateurs from professionals. Losing streaks. Anyone can stay calm when trades are winning. Confidence is easy when things go well. But what about when you take 3 losses in a row? 5, 10. This is where most traders crack. Not because their strategy stopped working, but because their belief in it did. A losing streak feels personal. It triggers doubt. You start thinking, maybe this system doesn't work. Maybe I lost my edge. Maybe I should tweak it. So you adjust rules midstream. You hesitate on valid setups. You skip trades. And ironically, the trades you skip are often the ones that would have recovered your losses. This is a painful cycle. A strategy's edge plays out over a large sample size, not a handful of trades. Even a system with a strong edge can have 8 to 12 losses in a row. That's normal. But most traders aren't psychologically prepared for that. They expect smoother results. Professionals think differently. They don't judge success trade by trade. They think in batches: 20 trades, 50 trades, 100 trades. They know short-term randomness doesn't invalidate long-term probabilities. Here's a mindset shift that helps. A single trade means nothing. It's just one data point. Your job isn't to win this trade. Your job is to execute your edge repeatedly. Think like a casino. Casinos don't panic after a few losses. They trust the math. They know that over thousands of games, their edge shows up. Professional traders adopt a similar mindset. They don't need to be right today. They need to be consistent over time. Now let's talk about routines. Many successful traders follow strict routines that protect their psychology. For example, they trade only certain hours when they're mentally sharp. They set daily loss limits and actually stop when hit. They review trades weekly, not emotionally, after each one. They take breaks after rough sessions instead of forcing trades. These habits sound simple, but simple doesn't mean easy. Most traders know these ideas. Few apply them consistently. Discipline isn't built in big moments. It's built in small, daily actions. Another powerful tool? Pre-commitment. Before entering a trade, decide everything: entry, stop loss, target, position size, invalidation point. Once the trade is live, your only job is to follow the plan. No mid-trade negotiation, because negotiation under pressure usually favors emotion. Here's a tough truth. You are not paid for effort in trading. You're paid for discipline. You can analyze charts for 10 hours, but one emotional decision can erase a week of good trading. That's how asymmetric this game is. Now let's address confidence. True confidence doesn't come from wins. It comes from following your process. If you followed rules and lost, that's a good trade. If you broke rules and won, that's a bad trade. This mindset shift is powerful. It focuses on behavior instead of outcomes, because outcomes are partly random. Behavior is controllable, and control is where consistency lives.
Let's talk about identity. Because at some point, profitable trading stops being about charts and starts being about who you are becoming. Most struggling traders still carry a gambler's mindset, even if they don't realize it. They chase excitement. They look for big wins. They want fast results. They feel bored when markets are slow. That's not a trading mindset. That's a dopamine mindset. Professional traders think differently. They don't trade for thrills. They trade for consistency. They don't ask, how much can I make today? They ask, how well can I execute my plan today? See the difference? One focuses on money. The other focuses on process. And process-focused traders last longer. Here's a powerful shift. Stop trying to be a winning trader. Start trying to be a disciplined one. Winning is a byproduct. Discipline is the cause. Now let's talk about patience, the most underrated trading skill. Patience isn't just waiting for setups. It's waiting for your edge to play out over months. Many traders quit too early. They try a system for a few weeks, expect instant results, then jump to something else. Strategy hopping destroys progress because no system shines in a tiny sample size. Even strong strategies have rough periods. If you switch every time results dip, you never experience the profitable side. Think about learning any skill. You wouldn't go to the gym for 2 weeks and quit because you're not fit yet. But in trading, people expect rapid transformation. The market doesn't reward impatience. Now here's something deeper. Your environment affects your behavior. If you follow hype traders, flashy profits, 10% win rate claims, you'll feel constant pressure. Pressure leads to forcing trades. Forcing trades leads to losses. Professional traders often build quiet environments, minimal distractions, clear routines, limited opinions. Because too many voices create confusion, and confusion weakens discipline. Let's touch on long-term thinking. Short-term thinking says, I need to make money this week.
Long-term thinking says, I need to build skills and consistency this year. One creates pressure, the other creates growth. Ironically, traders who focus less on money often make more of it because they're not emotionally chasing it. Now ask yourself honestly, are you trying to get rich quick or trying to get good first? Those paths are different. Getting good requires repetition, review, patience, self-control, realistic expectations, not viral strategies, not magic indicators. Here's a truth few say out loud. Trading success is boring to watch, but exciting to achieve. It's routine, structured, measured. No drama, no impulse, no chasing, just steady execution. And that's why most people quit, because it's not as thrilling as they imagined. But for those who stay, who mature psychologically, who treat trading like a craft, the rewards can be real.
Let's bring everything together. By now, you've seen a pattern. Trading isn't won by the smartest person. It isn't won by the person with the most indicators. It isn't won by the person glued to charts all day. It's won by the person who can manage themselves. Because at its core, trading is a mirror. It reflects your discipline, your patience, your emotional control, your habits, your mindset. The market doesn't create your weaknesses, it exposes them. If you're impulsive in life, you'll be impulsive in trading. If you struggle with patience, trading will magnify it. If you avoid responsibility, you'll blame the market, news, or bad luck. But when you grow as a person, your trading improves too. That's why trading is one of the most personal development-heavy careers out there. Now here's the ultimate mindset shift. Stop trying to conquer the market. Start trying to master yourself. You can't control price. You can't control outcomes. You can't control randomness. But you can control your risk, your rules, your reactions, your routine, your preparation, your discipline. And that's enough, because long-term profitability comes from controlling what you can. Let's make this practical. If you truly want to level up as a trader, focus on these 5 pillars. 1. Risk management. Never risk so much that emotions take over. Small risk keeps you calm. Calm keeps you consistent. 2. Clear rules. Vague systems invite emotional decisions. Clear rules reduce overthinking. 3. Routine. Trade at set times. Prepare before sessions. Review after. Structure builds stability. 4. Journaling. Track behavior, not just trades. Patterns reveal themselves over time. 5. Long-term thinking. Judge progress over months, not days. Think in samples, not single trades. Now here's something important. You don't need to be perfect. Even professional traders make mistakes. They feel fear. They feel doubt. The difference is they return to discipline faster. They don't spiral. They don't chase. They don't let one bad day become a bad month. They reset. They refocus. They continue. That's professionalism. And professionalism is what separates trading as a hobby from trading as a craft. If you remember one thing from this video, let it be this. Your edge is not just your strategy. Your edge is your behavior. A simple strategy with discipline beats a complex strategy with emotions every time. So instead of asking, what's the best system? Ask, how can I become more consistent? Because consistency turns small edges into big results. Trading is not a sprint. It's not a lottery. It's not a get-rich-quick scheme. It's a long game of skill, self-awareness, and steady improvement. And the traders who succeed aren't superheroes. They're just people who learned to manage themselves a little better each year. So take your time. Respect the process. Focus on discipline over excitement. Because in the end, the trader who wins is the one who shows up prepared, follows their plan, and keeps going long after others quit. And if you can do that, you're already ahead of most. So here's the final thought I want to leave you with. The market is not your enemy. Bad luck is not your enemy. Other traders are not your enemy.
Your biggest opponent in trading will always be you. Your impulses, your fears, your impatience, your need to be right, your urge to act when you should wait. But here's the good news. If the problem is internal, the solution is internal too. That means your progress is in your hands. Every day you choose discipline, you get a little better. Every time you follow your rules, even when it's uncomfortable, you build real confidence. Not hype confidence, not lucky confidence, process confidence. And that's the kind that lasts. One day you'll look back and realize trading changed you, not just financially, but mentally. You became calmer, more patient, more responsible, more self-aware. That's the hidden reward of trading. Money is a byproduct. Growth is the foundation. So don't rush it. Don't chase perfection. Don't compare your Chapter 1 to someone else's Chapter 20. Focus on becoming the trader who follows their plan, manages risk, and respects the process. Do that long enough, and results tend to follow. And remember, the goal isn't to win today. The goal is to be still here, still disciplined, still improving next year. Because the traders who last are the traders who win. Take your time, trust the process, and trade like a professional. I'll see you in the next video.